Hello friends, welcome back to our channel. You guys have requested a lot of topics, and one of the topics is very significant is departure tax return. So this video is for you. So if you are someone who has left or is thinking about leaving Canada, we're going to cover what all you need to know and how significantly it impacts you and what sort of things that you need to consider to avoid lots of significant penalties. We're going to cover all of this in this video. Leaving any country is a very significant step, especially Canada, where CRA needs every single penny of tax from Canadians. And whenever somebody leaves Canada, it's a very significant financial step. And CRA looks into in a deep, and you got to be very careful about dealing with CRA on tax matter when you leave Canada. But don't stress, we're going to cover all these in a basic English that we take pride in, that we talk all these matters in a language that you're easy to understand. So we're going to break down all these significant steps and matters when you plan or leave Canada for good. So when you leave Canada, you may need to report your investment, your income, your property, and your financial assets. We're going to break down all of these in this video. So when you leave Canada, any country doesn't like to leave a taxpayer going away. And there are certain requirements in certain forms that you need to file with CRA when you plan to do it. So if you're someone who is leaving Canada or is planning to leave Canada and has a total asset or financial assets of $25,000 and above, you need to report their fair market value on the form T1161. So if you're someone who owns real estate, bonds, investment, and non-registered fund, if you think that its fair market value is over $25,000, you need to report those fair market value on form T1161. However, there's a great significant exceptions to this rule is all your registered funds like your RRSPs and your TFSAs are exempt for your reporting. Filing all forms when you leave Canada are very significant and comes up with a significant penalty if you do not file it on time. So this form 1161, it also comes with a penalty of $2,500 if you do not file while living Canada. Now let's talk about filing another form called T1243. Where you need to report all deemed disposition of your capital properties while leaving Canada. What is deemed disposition? It means that if you own assets in Canada, even if you haven't sold it, CRA assumes that you have sold on the date when you leave Canada, and fair market value and all the capital gain that you have accrued or accumulated on your assets in Canada, you have to pay capital gain taxes up to the date of your departure. So when we leave Canada, on that day or on that year, any tax that we pay based on the final taxes, which we call the departure tax, this capital gain it's a part of the departure tax, which you need to pay in the year when you depart. And you can also pay by either by paying or giving a significant asset to CRA as a collateral for the payment. So when you determine that you owe departure tax, you can either pay or defer the taxes by giving CRA enough bond or security as a collateral towards your tax payment. So let's talk about what happens when you own a principal residence in Canada and you leave Canada. So you need to report that principal residence in a form called T2091. Be careful, there's a significant penalty of up to $8,000 if you do not report your principal tax exemption on form T2091. Principal resident exemption is very important because, as you know, that principal resident is a tax-free. Even if you deem dispose, the increased value up to the date of departure, you don't pay any taxes. So it's very important to disclose that value when you depart from Canada on form T2091. And don't stress out. You don't need to sell your property or sell everything before you leave Canada, because you can always maintain your property in Canada, including your principal residence, when you actually plan to rent it out after when you leave Canada. So in this case, you need to file your taxes on the rental income under section 216 with CRA for your rental property. So let's summarize. There are too many forms that we talked about this in this video. So it's a very significant event. When you leave Canada, nobody likes you to leave or taxpayer leaving their own country. However, as we discussed, we need to be careful about three forms, which the very first one was the T1161, where you list all your assets where you think the fair market value, the combined fair market value is over $25,000, but there are exceptions for your RSPs and TFSA. And then you need to report all the deemed disposition on T1243 of all your properties, then to calculate all the gains and losses up to the date of departure and report and pay the departure tax accordingly, or defer it by providing enough security to CRA. And the last thing we discuss for departure is filing for your principal residence is form T2091, where you need to report your principal residence and fair market value up to the date of departure, because the filing or non-filing of these forms lead to a very significant penalty of $8,000 per person. Leaving Canada and filing all these forms could be very overwhelming, but don't stress out. That's why we are here for. So we make this process stress-free and simplify this in plain English and hold your hands in step by step. We are very proud that we have done or helped out very many clients in the past couple of years and help them leaving Canada and settle abroad so that their income gets exposed not to taxes in Canada, and they still can maintain their property in their driver's license and their bank account here.